Hello, everyone, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market strategists, market practitioners, investors, educators, authors, money managers, strategists, traders, whoever else we can sit down with to pick their brains, just see how they are approaching the current market environment, try to learn some of their lessons learned in recent history, how they're dealing with market uncertainty, market volatility, and all the competing narratives we're dealing with here in early 2025. Today, a really fun conversation with Jay Hatfield. Jay is the Chief Investment Officer of Infrastructure Capital Advisors based in New York. I've followed Jay's work for quite some time. I actually interviewed him years ago in my Stock Charts TV days when I was running a show there. And actually, full disclosure, hold one of the funds that Jay manages, PFFA, which is an infrastructure preferred ETF, which has been a really interesting way to diversify away from kind of big AI, big tech, which becomes a huge bet in your portfolio if you're not careful. You know, talking with Jay is really, incredible knowledge about the market environment, great way of understanding all the nuances of the Fed, of tax policy, fiscal policy, how they all relate and translate into equity valuations. With someone like Jay, I think it's tough to just try to boil down, an incredible amount of knowledge, an incredible amount of work and effort that goes into the research process that informs their decisions in Infrastructure Capital Advisors. But I really enjoyed an opportunity to ask some questions about his year-end target, which is S&P 7,000, one of the more aggressive, more bullish upside targets for sure of someone that I've interviewed. And so just talking about how you back into that. And when he explains it, you'll find it's not that unreasonable, right? Especially given the strength that we've seen so far in January. We talked about how the Trump tariffs, which so many, including me, have been focusing on as a huge inflationary red flag with some, dramatic potential impact. He talked about how those are more political talking points in his view, and instead it's all about corporate tax policy, particularly tax reductions. He sees that as being a huge tailwind for companies listed in the U.S. We talked about the Fed outlook. We had the Fed meeting, of course, this week. So we talked about his expectations, the terminal rate, using the 10-year Treasury Yield to back into a terminal rate for the Fed, which I thought was a really interesting way of relating those two, parts of the yield curve. We talked about takeaways from Magnificent Seven earnings this week. We've had Apple, Microsoft, and others that have been reporting here recently. I thought he had some really good points about the investability of those names beyond current levels, the potential impact of a strong dollar, and many other things. Finally, I think what I really enjoyed was just being able to ask him about positioning. We talked about how you navigate through challenging periods, challenging weeks with a lot of sudden movements like we experienced this week, Monday with Nvidia gapping lower. I appreciated being able to ask someone like Jay how he kind of navigates through that kind of period. We talked about using alternatives. A number of the funds that they run at Infrastructure Capital Advisors are you looking at non-sort of traditional equity asset classes, things like real estate and MLPs and preferreds. So it's interesting just thinking about and hearing Jay's perspective on how those could help round out your overall portfolio. And finally, I asked him about small caps at the very end, and I hope you listen to that point as well. Overall, a really enjoyable conversation with a smart, knowledgeable investor, and what a great blessing and opportunity to be able to chat with Jay and ask him some of these questions. So please enjoy this recent conversation with Jay Hatfield, the Chief Investment Officer of Infrastructure Capital Advisors. So a pleasure to sit down today with Jay Hatfield. Jay's the CIO of Infrastructure Capital Advisors, coming to us from New York. Jay, good to see you again. Happy January, and thanks for coming on the show.
Thanks, David. It's great to be on your podcast.
I know that you have a year-end target for the S&P 500, 7,000. I'm curious if you could just give us a high level. What sort of motivates that? Pretty aggressive upside target, certainly possible, and in some ways likely if we have the right sort of conditions to do so. What suggests that sort of level looking down the road in your work?
Yeah, so it's important to focus on the underlying numbers because opinions are worthless, facts are critical. So we're assuming 22 times earnings as a multiple.
Yep.
But we'll have a separate conversation on this, but does imply lower interest rates. So interest rates and multiples are inversely correlated. but we're looking at 26 earnings. So that's just a basic mistake. If you're going to year-end target 25, you look the forward year. And in fact, that's what drives most stock appreciation, is rolling 1 year forward on the estimates.
Yeah.
So the street consensus is about 305. We've raised that estimate. We don't like going in and saying, oh, we don't believe the IBM earnings are right, unless we have a model that shows that. Some strategists say, oh, I don't believe 305, it should be 250. I'm always like, well, why? Which company? Because we have models on this company.
Yeah.
The 305 is consensus. And then we adjust that up to about 322. And that assumes an 18% corporate tax rate. And it's not 15 because 15 has a lot of qualifiers on it. It seems like corporate taxes tend to be a little bit swept under the rug by at least the media, if not the Trump administration. And there is this reconciliation bill that requires a notional balanced budget, using funny math, of course. But so there are trade-offs, but that's one reason we'll touch on again that we actually like tariffs, because it could pay for the corporate tax reduction. So that gets us 322. That's our target. The street is roughly 6,500, 6,600. If we don't have a corporate tax increase, that's where we would be, still with more upside because of AI, notwithstanding the DeepSeek blow up, AI and deregulation, and will be lagging, but global monetary policy that's very stimulative.
It's interesting. Tariffs are something that have come up often. Obviously, there's a big source of debate, and it's still very much an open question about what the potential impact would be. But a lot of people see tariffs as a huge red flag, inflationary. This is going to be the big headwind to stocks. You're sort of thinking more on the tax policy side that's going to be more of a tailwind. Why are tariffs maybe a non-issue or less of a factor than I think a lot of investors are worried they will be in 2025?
The way we look at it is it's really a political talking point left over from the election. And keep in mind, there are no popular taxes in the world. Okay. I'm in Midtown Manhattan, and you wouldn't believe how much resistance there was to congestion pricing, which is a tax on coming into Midtown Manhattan.
For sure.
I think it's a good idea, but everybody hated it because taxes create losers. And so then the losers create talking points. And the talking points is that tariffs are inflationary, but there's a couple of nuances to it. You mentioned one already, which is it produces revenue, which everyone ignores, which shows it's a talking point, not economic analysis. And the second is it tends to strengthen the dollar. In fact, we have an ultra strong dollar. It was up as high as 10% since the Trump election became obvious. And that's actually more powerful than a 10% tariff, because it does things like depress oil prices, like all oil prices, not just imports, other commodities. It slows our economy at the margin. So it just shows you that nobody's really doing any analysis. They're just coming up with a one side to try to avoid something that may disadvantage them, or they're theoretically against, or they just don't like the current administration. And, by the way, particularly among large investors, I'm certain well over 50% did not vote for Trump, because they're all on the coast. They're not in Montana and, Cincinnati. They're on the coast. So big investors are going to be skeptical about Trump administration policies.
I think you've described political discourse in 2025 very well, Jay. Talking points with not enough work behind some of those. I hope that changes. I hope that improves over time. But boy, we're not seeing it necessarily yet. So the tax side, I guess the argument is lower taxes are a great tailwind for risk assets. Is that sort of what motivates your thesis?
Well, definitely, but I would focus it more. Yeah, because it's really. And again, we don't agree with Keynesians. We're supply siders is another way to say monetarists or kind of supply siders. They're demand siders. Like if you jack the consumer, then they consume more and then people invest more. We don't buy that at all. So what really drives economic growth, and you can see it cross-culturally across the globe, is investment. And the IMF has data out. You can Google it. So there's a lot of empirical data that says it's all about investment. So cuts in taxes on investment, which is really corporate taxes, is what drives stock prices, economic growth, and employment. Cutting taxes on individuals, well, we're not really going to cut some taxes, I guess, on tips, but really just going to extend the tax cuts. It's just government funny math that makes that a tax, decrease. But when you cut taxes for individuals, most of that goes to consumption and only a little bit to savings, which is investment. So it's much more efficient for growth to cut corporate taxes. So that's kind of our key message. Don't get all fussed about all these other policies that are basically immaterial. When this corporate tax cut could drive stock prices, I mean, we're assuming 18. If it's 15, we could get to 7,500 easy, with probably more like 8,000 being a better estimate. Because go back and look at 2017. Before the Fed tanked the economy by tightening rates in 18, we were just off to the races. Everybody was increasing bonuses. It was just hiring more, giving more to charity. Like when those corporations got those cuts, it was off to the races. Much more competitive globally, capital coming into the U.S. That's the key driver. So we think that everyone, including Republicans, are missing that as the key driver. Like some Republicans want higher corporate taxes because they're populists, but they don't recognize that these macroeconomic factors are very powerful.
Yeah. Talk to me a little bit about the Fed. We had the Fed meeting this week. I mean, sort of a non-issue in terms of the any rate change, but certainly a lot of people, hanging on, any sort of color in terms of what the rest of the year may hold, how many rate cuts we may see, what the terminal rate might be. Did you hear anything this week that sort of changes your thinking in terms of how Fed policy may play out? How big of an impact? What are sort of the key factors you're thinking about when you think about the Fed's impact on risk assets in the next 6 months or so?
Well, we've sort of mastered being a Fed whisperer in the sense that you have to understand where they're coming from. So they are almost all labor economists, which means they're Keynesians, which means they probably weren't big fans of Trump getting elected. So as soon as Trump was elected, they raised their inflation forecast from 2.1 to 2.5 this year for core PCE. We strongly disagree with that. Everything we see is deflationary, including possible Trump policies. So we're forecasting 2.1 at the end of this year. And in fact, we'll know soon. PCEs tomorrow. That's likely to print relatively cool, in line, but cool at 0.2, which implies 2.4 annualized. But the next month, we roll off a gigantic print. By the end of the first quarter, we're forecasting we're at 2.4, so already below the Fed's bad forecast. And so they don't know it yet, but they're going to cut 3 times this year. So, but we're not predicting. So we've gotten better at this because it doesn't really matter what we think. They're going to go do make their policy errors. But we do know that when the data comes out, they're kind of dumb but not stupid. So they'll be able to. They can't forecast at all. They've acknowledged this. But when PCE core is at 2.3, and we do think that we saw it today in the GDP report. Economic growth is attenuating because of investment. By the way, investment matters a lot more than consumption for cycles. That's just a fact. I could give you that data. But so we think slowing economy, lower inflation is going to force the Fed's hand, even though they want to, wring their hands about the talking points on immigration and tariffs.
What is so everything you just described makes a ton of sense. What does that mean for longer term interest rates, right? For things like the 10-year yield, we've seen quite a move, with approaching 5% again, retesting the highs we had in 2023. As you're looking at the trajectory of rates here, how do you see things playing out going forward? How much of a concern should that be for investors here at the end of January?
So the critical insight we have there is all of the increase. So from sort of the beginning of the Trump victory to now, well, at its peak, we went from 360, to 480. So 120 basis points. All of that was accounted for a change in what's called the terminal rate, expected terminal rate of Fed policy. And by the way, a lot of people confuse this. So if everybody all of your listeners get this in their mind, then they'll be way better than most people on television. Assume 100 basis points. Steve Mnuchin does it. That's what the 50-year average is between the Fed funds rate and the 10-year.
Okay.
So we think that the 10-year is going to end up the year somewhere between 350 and 4, call it 375. Well, that means that the terminal rate's going to be 275. And if the Fed chair was correctly saying that policy's tight. Well, I'll give you a simple way to figure that out. It's like, okay, the 10-year is at 450 and the Fed funds rate is at 433. That's, 12 basis points, right? So, or 17 basis points, sorry. So, and it's normally 100. So you don't have to be a genius to figure out that that's tight policy. So we think this whole narrative about the terminal rate is going to go away. But the reason I emphasize that is probably a lot of your viewers, worry about the budget deficit.
Yeah.
I've given up worrying about the budget deficit because I've been worrying about it for like 27 years since Bill Clinton was president. And it just that we are going, hopefully we get better, but most likely we're going to have a pretty big budget deficit. But all of these rates, like we had a 260 terminal rate or Fed funds rate in 2019, we had a big budget deficit. So saying 275 is not that big a deal. Maybe it's 3, so we have a range. But it's important not to get caught up in the budget deficit because that's kind of more like a political debate. And it's it's nice that people hate it, but it shouldn't affect your interest rate forecast.
Let's change a topic a bit and talk. Obviously, there's so many competing narratives. I wish we had a couple hours to go through each of these, Jay. But obviously, a lot of tech earnings this week. Earnings season started out quite strong with a lot of banks, with some strong numbers. All of a sudden, we get to this week, kind of mixed results with Microsoft, with Meta, Tesla, and others. What are you hearing this week when you look at these leading names, obviously with huge weights in the benchmark? How much would does the dollar weigh into some of these large mega cap companies that have done quite well with the dollar starting to strengthen? Does that start to threaten some of those non-U.S. revenues? Talk to us a little bit about how earnings this week affect your thinking.
There's no doubt that that's a headwind.
Yeah.
And usually investors kind of look through that, but it's a headwind. I think the real dominant theme is this DeepSeek bear thesis.
Yeah.
And we don't accept that. We do expect there to be competition. There's going to be winners and losers. For your older viewers, you might remember Webvan and some of the super dumb IPOs that occurred in the late 90s and early 2000s.
Sure.
It's going to be losers. I wouldn't want to have an investment in OpenAI at $150 billion valuation. So a lot of competition on the AI bots side. But in terms of these chip companies, there's going to be demand for chips. They're not even capitalizing in really huge growth rates. Like really 15, they traded 30, so that implies 15. Well, I would be shocked if we don't get 15% growth in GPUs. So we think the chip sell-off's overdone. We don't like Tesla. We think it's more of a meme stock for kind of Elon and Trump. So if you like to gamble, it's fine, but we don't think it's a good investment. It's all like basically an overvalued private equity firm with robo-taxis and robots, I guess. So we're not surprised. Well, actually, the stock went up, but it was just because the earnings are terrible and Elon talked the stock up. So all these companies do have their unique situation. Like we like Broadcom and Amazon because Broadcom has an underappreciated story about doing XPUs. So those aid GPUs in communication and certain specific calculations. We think that is exploding regardless of DeepSeek and exactly how many semiconductors are needed. And then we also like Amazon because they don't just have cloud services, they have their retail business and they're cutting costs very dramatically. And that's kind of underappreciated, but sort of an obvious low-hanging fruit because they have billions and billions of revenue and low net income. And now they have professional management. So growth, it's not growth at all costs. And it is, I would say, on a risk reward basis, it's quite attractive. So, when you own NVIDIA or even Broadcom, you have to suffer a lot of gyrations, but Amazon trades like kind of half Walmart and half Microsoft. So lower volatility. It's grinding higher, but without these kind of stomach churning drops because of the latest bear thesis. So that's a good, it's not conservative, but it's more conservative than a lot of large cap tech stocks. So you have to kind of go a company. I don't really like the Mag 7. They're mostly different types of companies. Meta is doing really well with because they're already applying the technology to their user base. So you kind of have to go. Apple's got their challenge with China. So there's going to be, as we've already seen, some winners and losers. Overall positive for demand, for productivity. Another issue on inflation. Nobody cares about productivity, only about immigration. But so tons of bull thesis. I don't think it's probably been ever an easier market to make money in since like the late 90s. So don't come up with some strange bear thesis that keeps you uninvested.
How do you, I know you've been in the industry for a number of years. How do you weather, I know a lot of investors kind of newer to the game. A day like Monday completely disrupts their thinking, their belief system. They're pretty much following the AI frenzy higher and higher. All of a sudden, NVIDIA gets, docked 20-some% at a moment. How do you weather those sorts of events, those kind of one-off black swan moments, and focus more on the longer term? What allows you to navigate those short-term, the noise, I think, that is just embedded in equities?
Well, there's really two things. The first is to double down on research. So if you have and everybody who does own individual stocks you don't have to have the models that we have, but you should know what multiple it trades at, what multiple of growth plus yield it trades at. So revisit your thesis. Maybe you lower your numbers. You can say, oh, well, this is a little different. So I don't think NVIDIA is going to grow at 20% a year. It's going to grow at 15. So maybe the multiple, or 17. So the multiple should be 35. That's a 2 peg.
Yeah.
So revisit your target. And then if you still think there's upside, what we do, and we do this both we have a hedge fund, but also we have 6 ETFs, is that we'll write covered calls, very short-term covered calls, and say, okay, everybody hates the stock we like right now. Probably not going to decide tomorrow that the DeepSeek was a joke. So if we have we don't have NVIDIA, any of our public companies or public funds, it's a little bit too risky, but we have a little bit of Broadcom. We'll just write some extra calls, even expiring this Friday or next Friday or the following Friday, at prices where, maybe you're close to your cost basis. And then you say, oh, okay, well, everybody hates it now, but at least I'm making money on those calls. Yeah. And so it turns you by trading into a longer term investor, and you don't do stupid sales where you blow out ABGO at like 200 and now it's at 220. You might be down a little bit on the calls you wrote, because hopefully they're like 230 calls, but maybe it gets called away, but it's 15% higher than where you sold it. So it doesn't really, if it's going to 100, that's not going to help. But if it's a shorter term phenomena, it's a freak out, you actually can make money from other people's stupidity.
Thoughtfully using options. I think that's a great way to describe it. Jay, so you mentioned the ETFs that you run, and I know a number of your ETFs really get into sort of alternative asset classes outside of equities and bonds, right? A preferred ETF, which, full disclosure, I own PFFA in my own accounts for a number of years.
Congratulations.
Thank you, Jay. It's been great. MLPs, REITs. Talk to us a little bit about how in an environment where it feels like the market, and it's certainly market psychology, has been dominated by AI and growth, what's the argument for owning some of these other asset classes, having exposure to these other spaces? How should a thoughtful investor be positioned now, sort of considering some of these other asset classes?
Well, we think even aggressive investors should be in preferreds and high yield bonds. We launched BNDS as our high yield bond fund. And the reason for that is you get almost equity-like returns with way lower volatility and really good income. So even if you're a younger investor, if you hold high yield bonds or preferred stocks for 40 years, you still probably get like a 8, 9, 10% compounded yield, but with way lower volatility. So we do think, and preferreds, we're able, the reason I said congratulations is we have had the best returns of all ETFs, high yield ETFs, bond ETFs, and preferreds. And the reason for that is that, as we were talking about stupidity or irrationality, preferreds are more volatile than actually high yield bonds. There's a lot of irrational trading, and we're able to take advantage of that. And there's big index funds that dislocate the market. We take advantage of that as well. So with fixed income, we do believe in active management, and we do think even in more aggressive portfolios, there's room for those two securities. If you have a lot of lower risk fixed income, it's good also because you take less interest rate risk and more stock market risk and good yields. And then we take asset classes that everybody's likes to hold, like large cap stocks, ICAP. We do write the covered calls I was talking about, very short term, hard to do in your PA because you've got better things to do, hopefully. We don't. But SCAP, we write some index calls that adds extra income, lowers volatility. AMZA is a pipeline fund. We do smaller calls there because it's very correlated because it's energy. But there you get better tax characteristics because you get the pass through of the depreciation because we hold MLPs. We have a corporation, but we get all that tax shelter and it reduces our corporate taxes. Then we distribute that as a 1099. So it's really 5. We have PFFR as an index fund, but usually we steer people to PFFA because it's active. So we have 5 ways to add substantial income to your portfolio without, hopefully without reducing your long-term returns. So you get both income and return.
That's well said, Jay. And one of the funds you mentioned, ETFs, the SCAP is a small cap income ETF. Final question. I feel like the return of small caps has been announced a number of times in the last 12 to 18 months, sort of failed to really continue to, emerge and really outperform. You think 2025 is the year when we start to see small cap improve on a relative basis relative to some of the other indexes?
We do. I would just quickly mention that with small caps, we also believe, self-serving but accurate in our opinion, that it's important to either curate those names yourself or hire somebody like us to do it, because about 30% of the index loses money.
Yeah.
And that's not a good, I would argue that's not a good investment strategy to buy money losing companies.
Yeah.
So our fund has actually done quite well. But in terms of the index, the way to think about that is it's just a slightly more risky version of buying non-tech stocks. So there's only about 10% tech in small caps. So like if you want me to perfectly predict what's going to happen with small caps, just call me up at 8:30 every morning and tell me what's going on with the 10-year, and I'll tell you what's going on with small caps. So 10-year is rallying, rates are good down, small caps are going to outperform. Opposite. Right. Also, I mean, sometimes if tech's doing really well, people just sell, value and income stocks. So it's in the value and income area. They're cheaper companies. They're likely to do well if we have an M&A uptick. So, but we have to be right. For that call to be true, we have to be right about rates going lower. They're 450 now. We're saying it go below 4. If we're wrong about that, probably tech stocks is a better place to be. The one call I'll just throw in quickly that we think is independent of DeepSeek or interest rates are investment banks. I used to be an investment banker. Yeah. This would be like, I'm nearly tempted to fire on an Hermes tie and go pitch an IPO, because this is a great year to be an investment banker. So Goldman Sachs, Lazard reported good earnings. Jefferies is in our small cap fund. Morgan Stanley. We think those companies kind of all weather securities for this year. We know we're going to have better or more favorable antitrust enforcement. We know we're going to have more AI IPOs. So that's like a table pounder, is that asset class, because we can argue about Amazon versus Broadcom, but we think it's pretty straightforward that those, if we're anywhere close to right about the market as a whole, that those companies are going to do really well.
Some great points in there, Jay. And so, from a technical perspective, certainly the financial sector really improving on a relative basis. Some of those banks really started earnings season off strong, and you're seeing them rewarded with some higher share prices here. Jay, this was awesome. I can't thank you enough for coming on the show. I feel like a lot of your answers could be mini master classes in how to think about different areas of the market. So I hope we can have you back on later this year to sort of continue the conversation. But until then, I want to thank you so much for giving us some time today.
Great. Thanks, David. It's great to be on. Great questions.
So again, I mean, as I mentioned in the interview, I feel like we just scratched the surface of Jay's expertise. And I talked to them after we ended the recording. He agreed to come back on the podcast through the course of this year. I hope we can get him on as a regular guest, because it was just great hearing someone like Jay and how he's navigating through a period like we've seen. So many competing narratives, and I think really focusing on what is important and what's not important is so valuable. So often we're surrounded by news headlines, things and websites and emails telling us this is the most important thing ever. And I feel like every little thing gets promoted as the most important thing ever by someone trying to capture our eyeballs. And I thought Jay really cut through that noise to focus on the signal, focus on the things that are really meaningful. And I really appreciated his comments about corporate tax reductions and the potential benefits there. How you back into an S&P 7,000 target. I mean, that sounds outrageous when you hear the initial number. At least that was my reaction. But hearing Jay describe it and talk about these conditions and how they could get to that point, I think really helpful. I think a lot of us are debating and discussing and struggling with what the Fed does in 2025, rate cuts, potential rate hikes, how long they sort of keep rates stable, what that terminal rate might be. And I thought Jay's answer was the best I've heard in terms of how to think about the relationship between the 10-year, the Fed terminal rate, and what that should mean for your portfolio today. Overall, really fun conversation. I hope you enjoyed that and took some notes, as I did as I was talking with Jay. If you saw me look down and jot things down as we were going, I hope you were able to do the same. That's it for today's episode of the Market Misbehavior podcast. I do want to remind you, if you want to take what we learned from someone like Jay and learn how to apply that in your portfolio using the tools of technical analysis. At the end, we were talking about small caps. We were talking about financials. We talked about big tech and Magnificent Seven earnings. I would argue charts are the best way to actually track how some of these themes we discussed in the show today actually are playing out. This is how we improve our market awareness, our situational awareness as investors, as I like to say. If you want to upgrade your own ability to use those tools and techniques, as I have tried to do every trading day, I hope you'll consider our Market Misbehavior premium memberships. If you go to marketmisbehavior.com/premium, you'll find all the information you need to know. Don't forget to use the code PODCAST when you check out for a special deal on your first 12 months on any plan. 3 main benefits to the premium membership: virtual courses. We're actually in the process of adding a new course focusing on specific technical indicators, but we already have our flight school on behavioral investing, a bunch of webcasts covering a number of different topics, all available on demand, so you can really upgrade your understanding of the tools and techniques you may need in 2025. We also have a series of members-only reports, like our weekly flight plan, which goes out every weekend, our monthly chart review, which I'll be working on next week. These are all ways that we look big picture at the market trends, how they're changing, how they're evolving. I guarantee if you join me for those reports, your ability to understand and appreciate and recognize shifts in trends will be upgraded. Finally, we have a members-only community which you'll be able to participate in. It's a place to ask questions in a judgment-free zone for investors. There are people just getting started, people that have been investing for many decades, all weighing in. If you ask questions, I'll be in there every day throwing in some comments. You might find some of my other premium members weighing in as well, because some of them really know their stuff as well. So I hope you'll consider it. Go to marketmisbehavior.com/premium for more information. Again, don't forget to use the code PODCAST when you check out for a special deal in your first 12 months on any plan. Thanks so much for joining me today on the Market Misbehavior podcast. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts.